This is Bazaar Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Monday morning, bright and early start of a new week. We are coming to you live from the CNBC-TV18 Motilal Oswal studios as always. And I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, morning.
Hi, good morning, Prashant. Good morning, Nigel.
Good morning.
Well, indeed, a brand new week and lots of cues as well. It's the fag end of the earnings season, so we have so many stocks to look at. By and large, the Nifty has been sort of facing a bit of resistance around the 22,000. Let's see how this week goes.
Well, indeed, end of earnings season always brings a smile on your face, right? It's next couple of days is going to be quite gruesome. And then Prashant tells me he's got some big plans for Valentine's Day as well. So all the best, mate.
The month of love.
The month of love, huh? All right, well, let's just make it a day of love for the markets if possible, right? But it's looking a little skittish still, and I'll tell you why. Let's just pick up from where we left off on Friday, because there was no follow-through, and that's been, something we've harped over and over and over again. So Thursday, the market sold off post that RBI action. The Nifty ended down 200 points. And like what we've seen for the last fortnight or so, there has been no follow-through. So on the downside, that is, and the market actually ended about 1/3% higher. But now 1/3% is neither here nor there. Nifty Bank, of course, was more substantial. It ended about 1.25% up. And we'll talk more about that. So essentially, day two follow-through on the indices has basically remained elusive. Now, global markets, word in the US market, which is looking actually very strong. And you may complain that, well, it's not S&P 500, but it is S&P 5. Because, 5 stocks have contributed to the bulk of the gains on the S&P 500 this year, right? The big, mega, large caps on the technology side. But that aside, the index is what it is, and we made a record close on the S&P 500. Ended about 0.5%, 0.6% higher. The Nasdaq was even stronger with about 1.25%. So, if you want to broadly look at the drivers, stronger earnings, much stronger than, by the way, the US earnings season for the fourth quarter there has been much stronger than what we are seeing here. And I'll come to our earnings in a bit from now as well. And of course, this is something new. Markets are responding to good, strong data in a positive way. And that is the reason why I'm asking, is good news starting to be good news once again? Because, good news was perceived as bad news because rates would need to be higher. But I think there is a bit of a regime, maybe a mini regime change, which is happening in the sense that data in the US has been very strong. Rate cuts have been pushed out, but the markets are sort of viewing this in a positive kind of way. We get more. We get the US CPI, which is the big macro focal point in the US. And I think that will focus attention on the inflation numbers. The 10-year is at about just under 4.2%. Oil prices, they rose a little bit on Friday. They're at about just under $82 a barrel is where oil prices are. So that's the macro kind of a picture that we are looking at. Let's just move the graphics along. China, by the way, is on a holiday for the entire week. And this is, in a way, important because that's the market which has been falling and falling and falling. And then there's been a bit of a rebound. But no price action out of China for the next 5 sessions, actually a little more. Now, just to circle back on the levels here on the index, on the downside, important levels for the Nifty are the 20-day moving average and the 40-day exponential moving average, which have only changed a little bit from last Friday. Just under 21,700, which is about 80 points lower from where we are. That's the 20. And then the 40 exponential is at 21,450, which is a little lower. Break of these will confirm that maybe the market is in a bit of a pullback kind of a mode. The upside is 21,900 broadly, and that's an important support, a resistance which the Nifty has found it difficult to take out. We've been in a ranged kind of price action. For the Nifty Bank, resistance again is at the 20-day, which is at 45,972. Remember, we got a decent rally on Friday. And if HDFC Bank can start to bottom out a little bit and start to lend a little bit of hand of support, things on the Nifty Bank will look better. And of course, there's the 40 exponential, which is at 46,176 on the Nifty Bank. These are resistance levels. On the downside, in the very, very near term, keep supports at about 45, 600 or so. That should be the broad kind of support levels. GIFT Nifty will come up on your screen. and we'll get an indication of how the price action is starting. I think a lot of the focus is not on the index anymore, it is on stocks, because as we discussed, earnings season, fag end of the earnings season, and so much is happening both on the upgrade side and downgrade side as well. 90 points, will that sustain? I mean, it's a fair enough reaction given the sharp rally in the US, but the question is, is it going to stay through the course of the day, and will we actually be able to build on it? So fingers crossed as far as that is concerned, because the texture has looked a little ranged without a real follow-through missing. Sonia.
Oh, absolutely. And today looks like it's going to be a pretty good day, right? A pretty good start for the market, up almost about 95 odd points. Let's see how we can take it from there. But give and take everything, this market has been very, very range bound. The Nifty has been in consolidation mode, and we've been facing a bit of resistance around that 22,000 mark on the index. Now, the flows have been thinning out as well. So just take a look at some of the numbers on your screen. FIs barely bought about 140 crores in the cash markets on Friday. DIs sold about 420 odd crores. So we've been gravitating in this range of 21,500 to about 22,000 as a resistance for the market, and on the downside about 20,500. So, it's been this 100, 200, 300 point trading range. We're looking at some good numbers that came in from a lot of post-market hours numbers that came in post-Friday. So Hero MotoCorp was one of them. Revenue growth very strong. Margins up 250 basis points year on year. Industry-leading numbers from Honasa Consumer as well. Strong 28% revenue growth, volume growth of 35%. So this consumption space has been doing well. On the downside, though, it was a muted set of numbers coming in from Tata Power. So the revenue growth was barely about 4%. The margins were absolutely flat, and the coal profits fell about 81%. In fact, there are many downgrades on Tata Power that have come through post the numbers. Nuvama has downgraded Tata Power to a reduce. Elara has downgraded it to a sell. So, just keep an eye out. In the fag end of the earnings season, generally you tend to see a bit of accidents like this. So some disappointments coming through on some of these larger names. But be that as it may, today is expected to be a good start. The global cues have been solid as well. It's been, 3 or 4 weeks of a big move on the upside, or ending in the green for most global markets. And perhaps we can pick up from there. 90 points in the green now is what the Nifty implied opening is suggesting. But what are you looking at this?
Well, Sonia, on Friday's trading section, actually it appeared that there was a bit of a rejig or some rotation that took place on the key indices itself, because the Nifty Bank, that was an underperformer, that became an outperformer. And if you look at the broader markets, they were relative underperformers. So I'll be interested to see whether or not the broader markets, they want to consolidate, maybe see a little bit of a time or price-wise correction, because that's been the space which has made the big money out there. So, we'll have to keep an eye out on that. What took place, though? Why did we see such a big bounce from the day's low? Well, there was the short covering bounce that played out both on the Nifty as well as the Nifty Bank. That means the indices ended higher. And you had the open interest that was lower. Even the FI data, well, it perfectly ties in out there, because they covered close on 5,000 short contracts. They added close on 3,000 long contracts. So there was a swing factor of close to around 8,000 contracts out there. They continue to remain net short, though, with close to around 64% of the positioning on the short side out there. The Nifty Bank, that saw a good bounce from the lows. And the chart should come up for you on the screen, and that will tell you the perfect picture. The 200 DMA, that was visited, but that wasn't decisively crossed. So the 200 DMA is the mark from where the Nifty Bank did see a bit of a bounce. If you just pull up a graph, it'll give you a better sense out there. Now the question is, can we get past the 20 DMA? Because the 200 DMA has got defended. On the option side, well, the 21,800 call, the 21,500 put, well, both of them were fairly active in trade, which gives us a broad range. So the options data suggesting that the bulls believe they can defend 21,000 on the downside, 21,500 or thereabouts. On the upside, the bears believe they can protect this 22,000 odd mark. So that's what the options data suggesting. In the near term, the 20 and the 50 DMA should come up for you on the screen. That's the near-term supports that you're looking at if you have taken a long trade out there. The stock that I'm looking at is ACC. It made a fresh 52-week high. Remember, the numbers look very, very good. They reported their highest ever EBITDA per ton in the last 10 quarters. And there was a good up move that we saw. Stock at fresh 52-week high. There was fresh long build-up in the future space as well. And there was a fair bit of delivery-based buying if you compare it with the recent averages as well. So that's why I just think maybe that's the one you should focus on. Numbers look quite good. And maybe the next leg of expansion for Adani Cement could come in from ACC Limited. So that's the stock that I'm looking at. But as I said, need to build on to these gains that we're seeing on the gift Nifty. So let's see how that goes, Sonia.
All right. Thanks a lot, Nigel, for that. So lots of big cues lined up as we begin the day's trade. But let's very quickly tell you, give you some opinion rather. On the equities front, you have Jonathan Garner of Morgan Stanley, who says that Asia and emerging market equity markets have had a highly divergent start to 2024. Consistent with their new era thesis, he expects the structural outperformance of Japan and India, both driven by nominal GDP and a capex digitization agenda, reinforced by multipolar world de-risking trends. Okay, that's a mouthful, but but that's the expectation there.
Absolutely. Well, let's get you some money market views as well. B. Prasanna of ICICI Bank says exceptional strength in jobs data and gradual fading away in pricing of early rate cuts by the FOMC, supporting the dollar in the near term. He says Asian currencies weakened after soft Chinese data and dovish BOJ commentary. That's Bank of Japan. The rupee, however, he says remained in a tight range, aided by RBI intervention and hawkish MPC outcome. He expects the rupee to maintain in a narrow range between 82.8 to 83.2 to the dollar in the coming week.
All right, and on the bonds, B. Prasanna says global yields hardened last week, thereby unwinding aggressive rate cut pricing in the wake of continued stronger than expected data prints. He says back home positive momentum in bonds faced a setback post the MPC, resulting in higher yields. In spite of waning supply and continued strong investor demand, he expects the yields to consolidate, with the 10-year benchmark bond yield likely to trade in a range of 7.05 to 7.15%.
Well, we have a lot of stocks for quick action to track for you today. We get to that in just a bit. For the time being, we run you through the list though. Dr. Reddy's, ONGC, you have Hero MotoCorp, Oro Pharma, PI Industries, as well as Hunasa Consumer. All of them will be reacting to positive news flow. On the flip side, Tata Power, Divi's, Bandhan Bank and MCX will be reacting to negative news flow.
All right, well, that's basically the stock list, which is coming up for discussion in a bit from now. But Ed Yardini is president at Yardini Research. He's joining us now to take some questions. Ed, good morning. Great to have you with us here. 5,000 plus on the S&P and high levels coming. And you've been calling that for a while, calling for that for a while. The problem, not the problem, but some of the skeptics, and there are enough, saying that there's a fair bit of intermarket divergence in the US as well. The Russell 2000 is not down in the dumps, but is doing very poorly. And, this rally is being driven by just 5 or 6 names, large names on the S&P. The intermarket divergence is never good. I mean, it has to resolve one way or the other. Your thoughts, Ed?
Well, it's really not quite accurate. If you actually go back to the start of the bull market in October 2022, you'll find that there are several sectors and industries other than those that are directly related to technology and communication services that are up by 20% or more. And then the ones that are lagging have seen low double-digit increases. And it's really only utilities and real estate that has basically not moved at all since the start of the bull market. So there have been lots of opportunities to make money in different sectors. I think what's really going on here is that the mega cap 8 have simply done so well that they left everybody else in the dust, but everybody else has done pretty well also. So that's really, I think, what characterizes this market.
Ed, for the Russell 2000, and correct me if I'm wrong, I was reading that profits for the quarter are down some 25% for the Russell 2000 group. Is that correct? I mean, is there a big difference?
Well, I'm not a big fan of the Russell 2000. I much prefer the S&P 600 small caps. It's 600 names instead of 2,000, and the S&P 600 has a higher standard, if you will, for the success of companies, for their earnings ability. There are a lot of companies in the Russell 2000 that lose money. That's nothing really new, and so I prefer to invest in companies that actually have earnings. And for the small cap and mid caps, I think you're better off looking at an index like the S&P 600 for the small caps and S&P 400 for the mid caps.
Ed, hi, good morning. How are you feeling about the Indian markets now? The going has been great so far, but there are some hurdles that this market is facing at higher levels. Do you think we can get past them? And will India continue to be the preferred pick within the emerging market space this year?
Well, I think India continues to be a beneficiary of the geopolitical tensions, particularly those between the United States and China. I know that the Chinese government, President Xi, has kind of reached out to American investors, American capitalists, and basically asked them to come back. But there's a lot of skepticism about whether the Chinese Communist Party really wants to provide the kind of economic environment in which capitalists can thrive. And we can see this for their attempt to manipulate the stock market. It's very embarrassing for them to see their stock market down by over 50% over the past 2.5 years, because that's clearly a reflection of how bad the economy is and how badly it's been managed. And on a relative basis, I'd say India sometimes appears to be more chaotic, but it's also, I think, a much better environment for capitalists. And I think we are seeing India benefit from capital leaving China and moving to India.
Indeed, Ed, and the screen is telling us that as well. We have a plate out there which tells us that the Indian market's up 20% in the last 12 months. The Hang Seng is down close to around 25% odd. And we have a big week in terms of US data. You have the CPI number that's out. There's going to be retail sales number. You have 8 Fed speakers this week. So it's a rather big week in that sense. Add to it some manufacturing data as well. What's your view with regard to what happens on the Fed's rate cut trajectory? Are you factoring in that from May itself we'll see that, and quantum as well?
Well, I think this week the Fed is going to get data that confirms that inflation is continuing to moderate. And I think it's going to get some data showing that the economy is slowing a bit. Retail sales could be on the weak side. Industrial production could be on the weak side. So we may have a week of data that favors the Fed moving sooner in terms of lowering interest rates. But the Fed really, I don't think, wants to do that. I think the Fed recognizes that the economy is doing well enough that if inflation continues to moderate, that's a good thing. Why mess with success? And so I think the Fed is not going to go for a rate cut in March, maybe not even in May. I think the first rate cut comes in the second half of the year. And so I think all in all, we'll get maybe 2, maybe 3 rate cuts this year. I don't think we're going to get the 5, 6 rate cuts that some areas of the markets are still predicting.
Okay, all right, Ed, we'll leave it at that. Thanks a lot for joining in and giving us your view on the markets and the way forward. So don't expect too many rate cuts from the US Fed this year around. Let's slip into a quick break on that note. There are plenty of stocks to watch out for as it is the fag end of the earnings season. Our entire team will be with us to help you with that list. Welcome back to Bazaar Morning Call. Our entire research team is standing by to give you the list of top 10 stocks, and there are plenty to talk about. First up, Tata Power on our radar. It was a muted set of numbers this time. So Vivek is here to give us the fine print. Vivek, morning.
Well, good morning. As you mentioned, slightly subdued quarter from Tata Power this time around when you're comparing to our poll. But the earnings trajectory as well as the earnings trends this time around significantly different compared to what it was just a couple of quarters ago. So revenues higher by close to 3.7%, slightly below our poll, but coming in quite healthy at 14,651 crore. EBITDA higher by a little over 3.5%, slightly below our poll, but coming in over the 2,400 crore mark. Margins, flat on a year-on-year basis at 16.5%. Net profit up 2.3%. That is slightly beating our poll. Now, what's actually happened is that, till a couple of quarters ago, the analyst community believed that a majority of the profits were being driven, given the fact that Tata Power has a net long coal position due to the presence of the Indonesian mines. Now, this particular quarter, what's happened is 75% of the total profits have come in from the core businesses, just around 25% from the Indonesian or net long coal position, which is what has hurt the company given the fact that coal prices have dipped quite significantly. But despite that, the earnings trajectory has actually improved on the back of this particular contribution of 75%. Number 2, what was key to watch out for was the 4.3 gigawatt solar module power plant, and that is on track. 2 gigawatt is already being commissioned. And lastly, the company has a very strong solar EPC order book, well over 15,880 crore this time around.
Okay, all right. Thanks a lot for that, Vivek. In fact, we'll have the management joining today on Bazaar at 10:15 a.m. later today. So stay tuned for that conversation. But let's talk about pharma names. Then Ekta joins us to tell us about Dr. Reddy's. Morning, Ekta.
Morning. Well, important and positive news which is coming for Dr. Reddy's this morning. The company's FTO03 unit has been classified as voluntary action indicated by the US FDA. It was inspected from 19th to the 27th of October and was issued 10 observations at that point in time. So the street was fearing that there would be some escalation of that, but the company has informed the exchanges that they have received an establishment inspection report with a VAI, which is a voluntary action indicated status by the USFDA, indicating that they can continue manufacturing from this unit. And remember that it contributed around 30% of the company's US revenues, this particular site, and hence it should be a relief for Dr. Reddy's today.
All right, Ekta, thanks very much for that. Let's talk about ONGC next. Sonia? All right, I think Sonal is with us to run us through the details on that one. Sonal, hi, morning.
Good morning, Prashant. Well, ONGC was largely in line with what the CNBC-TV18 poll suggested, but it was a decline on a sequential basis as expected. Revenues were down 1%, EBITDA down 6.5%, margins were lower at 49.3%, which compares with 52.2%, profits down 6.7%. They are largely higher than the poll. That is because other income was higher on a quarter-on-quarter basis to come in at 3,400 crore rupees. Now, in terms of key internals, their crude production was down 3% on a YY basis. Gas production declined 4%, and crude realization absolutely in line with estimates at $81.6 per barrel. So going forward, the crude oil movement will be key to track for crude for ONGC, and also the production coming in from KG Basin.
Thanks a lot for that. Well, the other stock that we're watching this morning is Hero MotoCorp. Good set of numbers coming through, largely higher than what the street was estimating. So I'm expecting the stock to be in the green. A revenue growth of 21% is what Hero MotoCorp has reported this time at 9,723 odd crores. Even if you look at the EBITDA performance at 1,360 crores, it's higher than the poll of 1,319 crores. The margins have picked up to almost 14% versus 11.4% same time last year, and net profits are up about 5%. It's a mixed bag on the brokerage front actually. CLSA hasn't outperformed. They've raised their target price to 5,246, but a couple of others are a bit disappointed with the kind of margin pressure that we've seen quarter on quarter. So I'm going with green today because the numbers are better than what the street was estimating. But let's go back to Ekta to talk about Divi's Labs and how the numbers looked. Ekta.
Well, it's definitely a tough one to call a color on today because Divi's Labs, the numbers were weak. So revenue was up around 8.6%. Street was anticipating around 20% in terms of growth. Margins came in at 26.4%. Street was anticipating around 29% in terms of margins, and the profit at around 258 odd crores. But what the street probably would like with regards to Divi's Labs this time is what they said on the call. So the GLP-1 opportunity is expected to contribute FY25 onwards. The company is supplying amino acids for these GLP-1 drugs. Remember, these big weight loss blockbuster drugs. They are confident on double-digit growth in FY25, and they have said that the custom synthesis segment has 2 large projects from Big Pharma. The stock is corrected around 10% from its 52-week high, trading still at punchy valuations of around 41 times FY25. So let's see which way the stock goes. Based on just what they reported, the stock should probably be in the red, but based on the commentary, maybe we could see some amount of relief.
Okay, all right. So that's about Divi's. But Ekta, tell us about Auropharma.
Well, yes, Aurobindo came out with what you would have to say was largely a good set of numbers. So revenue was up around 15%. Street was anticipating 16% growth. The margins were better than estimates at around 21.8%, and so was the profit. US sales were better than estimates at $451 million. The street was anticipating $420 to $437 million. US specialty and injectable revenue was $112 million, which is around 25% of their total sales. The Europe, ARV and API business was sluggish, but the US sales will probably make up for that. They do have a call at 8:30 a.m. today, so the commentary again will determine a lot of the stock moves.
All right, Ekta, thanks very much for that. Well, PI Industries also reported. Sonal has got details. Sonal.
Well, strong set of numbers at a time when the industry is talking about headwinds. The company reported revenue growth of 18%. Their EBITDA was up 34%. Margins expanded by 300 basis points, and profits were up 28% as well. It was led by the exports business. That is where the company saw growth of 13% because of volume growth, and they commercialized new products as well. Domestic continues to be under pressure. But let's talk about pharma business. That is the newly acquired business. That's where it contributed 10% to the overall export growth, but it continues to be under losses. Domestic revenue was subdued with a reduction of 6% on a YY basis, and the company says in the domestic market pricing pressure could continue, but exports would continue to do well.
All right, thanks a lot for that. Well, Abhishek is with us to talk about Bandhan Bank and how the numbers looked. Abhishek, over to you.
Good morning, Sonia. So it looks like slippages have made Bandhan with Bandhan Bank for 12 quarters in a row as they remain elevated, and quarterly annualized slippage ratio is above 4% for 12 quarters in a row. So even in this quarter, the slippages are elevated at 1,390 crore. The annualized slippage ratio is above 5%, and asset quality has deteriorated in terms of absolute value. Gross NPA is up 3%. However, as a ratio, it's down to 7.02% versus 7.32% on the back of the fact that AUM growth has been strong. Net NPA has remained under control. They have sold off some NPAs in this quarter, which has led to a write-off of 720 crore. EEB book, that is emerging entrepreneur business book, over there the stress has increased as the amount is now under stress is at 7,500 crore, up about 8.7%. The heartening fact in the result was the sustainable of net interest margin on a sequential basis. Despite elevated slippages, net interest margin has come in at 7.2% versus 7.2% in the previous quarter. This time they had funded the balance sheet via bulky or wholesale loans, wholesale deposits, which could have costed them, but they have been able to maintain the margins. However, both the P&L in terms of NII and PAT is way below our poll. Back to you.
All right. In fact, we have the management on earnings in just a short while from now. So stay tuned for that. That's Bandhan Bank. But Honasa reported a good set of numbers this time. So Mangalam is here to give us the fine print. Mangalam, over to you.
Well, it's likely to be one of the stocks of the day in today's trading session, Honasa, because of two main reasons. One, in a sector that is, parched for growth, here's a company that reported 28% growth in the top line. If you compare like for like, it's actually a 31% growth itself. The second part is that most on the street were worried about expanding margins here for the company. Well, they've gone ahead and done just that. Year on year, the EBITDA has increased by nearly 200%, and the margins have doubled from 3.1% to around 7%. And as a result of which, on a low base, the net profit has nearly tripled itself. They've reduced the ad spends as a proportion of sales by close to around 40 basis points. What's good is that they've seen a 35% volume growth. They've increased their offline reach by about 37%. And while doing so, they've also increased their market share in both the face wash and the shampoo business. What's not good, however, is that quarter on quarter, the revenue and EBITDA have seen a bit of subdued moves. The revenue has declined by 1.5%, the EBITDA by about 15%. That's largely due to one, softer winter and harsh summer in the previous quarter, which led to a higher sales of sunscreens and face washes. So seasonality led to quarter-on-quarter weakness, but no complaints year-on-year. Good growth seen here.
Okay, all right, Mangalam, thanks for that. In fact, we'll be chatting with the management at around 9:50 a.m. later on in the show. Let's focus on MCX though. Sudarshan joins us to tell us. Sudarshan, numbers a little bit subdued?
Yes, so just for today, I'm going with red for MCX as headline numbers have come in below estimates. Company has reported loss of rupees 5 crore against profit of rupees 12 crore. That was an estimate. Also, it has reported EBITDA loss of rupees 20 crore against estimate of rupees 22 crore EBITDA. The important point in the MCX earnings is software expense. For this quarter, it was at rupees 146 crore, which is up 10% sequentially and 115% year on year. But need to note here that this was the last quarter of huge software payment. Lastly, company has shortlisted names for the post of MD and CEO, and the tenure of current CEO PS Reddy ends in early May this year.
All right, thanks a lot, Sudarshan, for that. Well, let's do a quick recap now of the top stocks with positive news flow. There's Dr. Reddy's, ONGC, Hero MotoCorp, Aurobindo Pharma, PI Industries and Honasa Consumer, while stocks with negative news flow, there's Startup Power, Divi's Lab, Bandhan Bank and MCX. But Sudarshan, you have more stocks on your list. There were many numbers that came in post-market hours. What stood out for you?
So I have divided these companies in two parts, good and bad. So first I'll talk about the companies that have reported weak earnings. First is Bajaj Healthcare. Revenue has slipped 18%. Also, company CFO Rupesh Nikam has resigned. Next is Paras Defense. Cost of material has increased 2 times and margin has slipped 340 bips year on year. Amber Enterprises has reported loss of rupees 0.5 crore against profit of rupees 15 crore year on year. EBITDA was flat at rupees 78.5 crore. Mishra Dhatu EBITDA has slipped 45% and margin was down 1400 bips year on year. Campus Activewear profit slipped 48%. EBITDA was down 39% and margin has fallen 800 bips to 11.9% year on year. One stock that might react positively to earnings, that is Advanced Enzymes. Revenue has risen 13% and margin is up 410 bips year on year.
All right, that's an interesting list, so, but more down than up, right, in terms of year-on-year comparisons, as you pointed out. So we'll talk about some of them with our guests in just a bit from now. Thanks for that. We'll take a break. Prakash Devan will be with us, and we'll throw some of these questions his way. So a conversation on markets, and then we'll be joined by the management of Stovecraft, who will be with us to discuss their third quarter performance. Stay with us.
Welcome back. Hope you're having a good morning. Well, to help us out with some analysis on the stocks that we just laid out for you, we have Prakash Devan who joins us on the show. Hi, Prakash. Good morning. Good to see you in. Well, what do you make of a couple of these nifty earnings that we got? You know, ONGC, how do you think those numbers were? And also Tata Power, actually. There were some brokerages that have gone ahead and downgraded the stock. Your view on it?
Well, good morning, Nigel. So let me take Tata Power first because I found the numbers pretty interesting and the view therefrom is quite opportunistic for people who don't have it. Now, if these downgrades or reduction in price objectives is an opportunity for people to get in, I think it will prove to be an excellent turning point of sorts, because whatever has happened is a very short-term kind of a impact that the numbers reflect. Whereas if you look at the way the company is kind of growing rapidly in most of the areas which have enough headroom for growth, it's just a matter of time before they catch up. What's probably impacting Tata Power in terms of flexing itself to grow faster than what the street would like to is the fact that they still haven't had that deleveraging impact which was anticipated, and it's probably got deferred even once more. And interestingly, the stock has run up in the last 2 quarters. From the last results to this result, if you see, it's a significant move. So probably that's one of the reasons why the expectations were built up a bit highly, and sense that that sense of disappointment that kind of seems to have crept in. But I think it's a great opportunity to buy into a company that has many more legs and is growing very rapidly. It's going to outperform most of the sector. ONGC, I think, is a steady state, Nigel. There's nothing very, in fact, given the fact that it's operating in an environment where oil has been fairly benign, they managed to do well given their large balance sheet and the large P&L that they actually report. But I would believe that if you look at wherever it is, whether it's the operating profit margins or whether it's the revenue growth, all of that's been fairly decently moderate in that zone. Most of it seems to be priced in, to be honest. So it's not something which is going to set fire to the stock or something, but it continues to reinforce the fact that these businesses, oil marketing companies, upstream oil companies, exploration businesses, all of them will continue to deliver even going forward. This quarter doesn't change the investment thesis from the long term.
Okay. The other stock I had to ask you was Hero MotoCorp, Prakash. The numbers look pretty good. I mean, 20% revenue growth, margins have improved, but the stock has also gone up, right? It's a 60% rally that we've seen in the last 6 months. You think there's more scope for upsides here in Hero MotoCorp?
Good morning, Sonia. So I was anticipating this because, on Friday, we all went into the weekend with the expectation that Hero MotoCorp numbers should be good given the fact that the way the stock was behaving. And I think the numbers will support that enthusiasm for 2 reasons. If you look at the setup, the rural economy-based growth that you would anticipate in some of these stocks, some of these businesses haven't really got completely triggered. I mean, there's still some time. If that were to happen, all these stocks would rally far. Hero MotoCorp would rally far more than some of the other names. While TVS is focusing more on the EV side, Bajaj is on the export side. Eicher probably has its own, strength in terms of, some of its new launches. Hero MotoCorp is the mass market, player where there could be some benefit that could be disproportionately favorable. And my sense is these numbers will support that. The important thing is the margin improvement. In a market like this where you don't sell too much, as much as the industry could expect, you at least make sure that your margins are in place, Sonia. And that's the tough part. Once revenues build up, once the unit numbers go up, then automatically, your bottom line is kind of padded with much more comfort. So I would believe there, while the stock's done quite well, and it's actually a catch-up after the other 2-3 names did well, it still has some journey to make. I would be quite positive on this name after the numbers.
Okay, all right, Prakash, request you to stay with us. Let's get the management of Stovecraft to discuss their numbers. Mr. Rajendra Gandhi, the MD at Stovecraft, joins us on the show. Hi, Mr. Gandhi, good morning. Thanks so much for joining in. Well, the past quarter's numbers are a little bit impacted because of that IT rate. But for the year, earlier you had told us that you're expecting to grow in double digits and margins could be in the vicinity. EBITDA margins could be in the vicinity of around 11%. Do you want to change that guidance? Because as of 9 months, you have grown at around 3 to 4%.
Yeah, the growth has not been in line exactly with our plans, but is also to do with the way the company operates. We are a cost-plus company. There has been a little softening on the cost, and we have grown upwards of double-digit, closer to the higher double-digit on volumes, but the revenue growth has been tepid. We believe that in this quarter, we'll be able to cover a lot of it and be closer to the double-digit growth. On the EBITDA number, yeah,
So for the year, sir, you're still saying that you believe you can grow in double digits, or will that be scaled down? Because as of 9 months, it's only 4%. Quarter 4 will have to be spectacular.
Yeah, the fourth quarter so far has been good. I don't want to guide you to be a spectacular fourth quarter, but the growth in the fourth quarter seems to be much better than the previous 3 quarters.
Mr. Gandhi, hi, good morning. For the last many quarters when you've come on, you've alluded to the fact that market conditions are not very positive. There is a little bit of softness which you are able to see. So how much of that is a factor? Because, it'll be important in that sense to understand your ambitions for FY25 as well. What should we expect?
We believe the markets are not very are very strong, but it is not. Neither do I want to suggest you that there is a weakness in the market. We are seeing good growth. I again mentioned you that in volumes we have been growing on higher double digit, and we continue to see the demand. In fact, we are getting into an election year. We believe that the year ahead of us seems to be very, very promising, along with our plans of launching in all the categories, new products in all the categories, particularly indigenizing several of them. So we believe that growth for us in the coming year seems to be very, very promising.
I know it's a one-time thing, the election bid, but can you tell us in 2019, for example, or other instances where you've seen a big bump up in sales because of elections, and how much?
We believe that historically we have been able to maintain a 19% CAGR for the last 5 years. But for this year, we believe that we can continue to grow at the same number. The opportunity is very promising. More and more consumers are getting into that affordability segment, which is what we are addressing. It is the largest segment. The opportunity in the country, in particular in the cookware and the kitchen space, is for a long time to come, is very, very promising.
But somehow, Mr. Gandhi, you are unable to capitalize on that opportunity. I mean, even if you look at your operational performance, right? Same time last year, 9 months of FY23, your margins were about 9.5%. This time it's fallen to 9%. You're not even able to get to double-digit margins despite having such a strong opportunity. Why do you think that is? And by when can you get to 10%, even maybe high teens margins, you think?
We have started the correction process. We have improved on our gross margins substantially. We were at about 32, 33%. We are closer to that 37, 38% now. This is where we wanted to be. So we will continue to improve on our gross margins, and definitely there has been a little overrun with several of new initiatives on new product launches and also on people side. So on these two things, we have become very cognizant of these costs. We believe that we'll be able to control these costs, and with the improved thrust on margin, we'll be able to get to the aspired EBITDA margin levels.
By when can you get to 10% margins? I'm asking because, you just mentioned that you have some product launches as well. So definitely your marketing spends must have gone up. Do you think that will put further pressure on your margins, and will it take you some time before you get to, 10%?
Now we believe that this year we will not be able to get to 10%, but going ahead from the next financial year, from for every quarter, that is our endeavor to get to upwards of 10. It's not even 10. We would ideally want to be at 11%.
All right, so average for next year will be around 11%. And I didn't get that number about your revenue growth for 24 as well as 25. What are you guiding for?
For the current year, we will be able to grow a little closer to 10%, if not 10%. But going forward, we believe we will get back to our historical 20%.
All right, and what's the outcome of that IT rate? Any clarity over there?
Yeah, see, we had this raid and the operations for both the factories at Himachal and at Bangalore were shut down for 5-6 days. This just definitely resulted in disruption both on manufacturing, and of course it was a peak time for us, also related to sales. There was an impact of this in this quarter. Otherwise, of course, we have no material anything to affect the company or the numbers. We have no such issues.
Okay, we'll let you go on that note. Thanks a lot for joining in. That's Stovecraft with an outlook on their business. But let's get back to the market. It's the start of a brand new week. Anuj is joining in now for a quick trade setup. Anuj, you know, things are looking a bit sticky around that 22,000 mark. Do you think it could take some time for the market to get above that level convincingly?
Good morning, Sonia. Yes, indeed. You know, and my sense is that there could be some more volatility. Last week, perhaps, was a teaser of things to come. You know, it's a bit of a cleansing out phase which is happening in the market right now. And I think it's concentrated more towards the PSUs. Last week was first sign of that happening. I mean, look at PFC, RVNL, SJVN, NHPC. All these stocks were down 5 to 8% on Friday. And in fact, from the highs, some of these stocks have already lost about a quarter of the market cap. RVNL, for example, and even BEML. So while the larger trend is still up, a sharp correction perhaps is possible. And the reason for that also from the index point of view is Bank Nifty, because it's been very volatile, down 800 on Thursday, then up 600 on Friday, tested the 200-day moving average for second time and again bounced back. Normally the third attempt of 200-day moving average is the one which breaks it. So it will be interesting to see if that happens. So there's more comfort in Nifty and Nifty IT compared to and Nifty Pharma compared to Bank Nifty. From here, of course, a lot of cues. Last week of earnings season starts today, and there's inflation data in India and US. So a lot of cues to watch out for. Brent crude is back up to $82, so that's a bit of a worry. But you know, I'm watching out for US 10-year bond yield as well. We had spoken about it last week. It's made a golden crossover. The 50-day exponential moving average moving over the 200-day moving average. I think that's important to track. As of now, not hurting the US market, but still keep an eye. Also, keep an eye on the PSU earnings, because the stocks have moved up, the earnings have been quite poor, and this week a lot of PSU earnings come out. That list will come up for you on the screen. And lastly, coming to the Nifty outlook for the day. You know, you start in the first resistance zone, which is 21,951 to 22,053, and then the bigger resistance, of course, is at all-time high of 22,126. The support comes in at 21,700 to 21,765, the 10 and 20-day exponential moving average, and then, of course, 21,600 to 21,650, last week's low. My sense is that the market will keep giving you two-sided moves this week as well.
All right, Anuj, thanks very much for that. We'll take a quick commercial break here. On the other side, our technical experts, Sudarshan and Kush Bora, will join in with their view on the market and specific trades they'd like you to take. Stay with us. Welcome back. You're with us here on Bazaar Morning Call. There's about 9 minutes to go for the pre-open session to kickstart. Sudarshan Sukhani is with us, and so is Kush Bora. Gentlemen, good morning. Great to have both of you here. Thanks very much. Sudarshan, you know, would you? The GIFT Nifty is indicating a higher start, but would you trust that and go with it, go long, or do you think it's still a very ranged market? And the better thing to do is to try and buy the dips.
Good morning.
Yeah.
Yeah, Prashant, good morning. It's a ranged market, but I would trust the breakout. You know, Nifty has been in a narrow range for 4 or 5 days. On Friday, I had suggested that a dip towards 21,600 should be a buy. Luckily, we got that. Now, the sense is that the Nifty is willing to break out of that small 4 or 5 day range. It doesn't mean we are going to see maybe not very big moves, but I think we'll see a move towards 22,200, the previous highs, so which I suspect would be challenged. So there is a tradable move here. I would go with the uptrend, go with the breakout. Ideally, of course, you always want to buy on dips, but that's a choice the trader needs to make. But for the Nifty, the trade is very clear. We must be long.
All right, we must be long on the Nifty. The trade is clear. Kush Bora joins in from kushbora.com. Kush, hi, good morning. Do you concur with the view that perhaps, it's better to be long in this market because eventually we're going to take out new highs? And what should the strategy be purely for today?
Hi, Sonia. First up, a very good morning. Well, if you're talking a slightly longish time horizon, and by that I mean like a month or maybe a little over than that, then for sure, staying long is the way to go in this market. But for now, I'll play the range. Let's respect what the market has been doing for the last couple of sessions, what the market has been telling us. So 21,600, 22,100 rather has been the range, and the market has been in that for a while. Also, this is concurred and confirmed by the option setup that we are looking at. So 22,000 still has a very strong call base, so that could turn out to be a very stiff resistance. For today, the gap up resistance, beyond that, the long position will not have a very favorable risk reward ratio. So yeah, for me, this market continues to be a buy on dip.
Okay, the market continues to be a buy on dips. Let's take it to individual stocks as well. What would be on your stock list today, Kush?
Incidentally, two stocks from the same sector. One is Siemens and the other is Thermax. Both the stocks have been, doing well. Siemens has been a bit volatile, but with a very strong positive bias. So for us, Siemens 43.65, 44.50 are the levels that we're looking at on the upside, and 4,200 rather is where we place our stop loss. One stock that gave a breakout, on Friday was Thermax, a very strong, sharp up move closing towards the high point of the day. We have a positional target on this one. 3,600 and 38.50 are the levels that we're looking at on the upside, and 31.50 is a strong support zone.
Okay, all right. Thanks a lot for that, Kush. Sudarshan, coming across to you. What are the picks you have for us?
Well, Ambuja Cement is a buying opportunity with decent rally and a trading range which should break on the upside. Buy with a stop under 565. Polycab continues to be an intraday short. That's a short with a stop above 43.80. The decline has not rebounded. Bajaj Auto is another buying opportunity. Look at the charts, steady uptrend and then small ranges, again breakouts. Buy with a stop under 76.50. And same chart for Cipla, decent uptrend, pauses and then a resumption of the uptrend. Buy with a stop under 14.15.
Okay, all right. We'll leave it there, gentlemen. Thanks very much for joining us. Appreciate it. 6 minutes to go for the pre-open session. We'll take another quick commercial break here. We'll come back. Prakash, of course, is with us. We'll address the pre-open. We'll also be speaking with the management of GIC-RE. The stock has seen a one-way move after the... actually going into the third quarter performance. Third quarter performance has been a bit tepid, so that conversation will be interesting as well. Stay with us. Welcome back. I think we are sort of hitting the pre-open. There's about 2 minutes to go with the session coming up. Prakash, of course, is still with us. Prakash, morning and thanks for waiting patiently. Just a few names. State Bank of India. Technically, there seems to be a bit of a breakout after almost 15 months of consolidation. Last 2 days, the stock has done quite well. And I just want you to comment. I don't know if if something is happening on Yes Bank. A lot of interest, humongous volume, stock has done what it has. Anything you're picking up there? There is that HDFC entity is allowed to buy so and so percent, but is that the really doing it for Yes Bank, or is there something else? Go on, briefly.
Good morning, Prashant. So, Yes Bank is something which is a clear manifestation of the FOMO that exists in the market. Of course, the FOMO seems to be ebbing a bit now with every passing day. But, if you recall the way, Vodafone Idea and Suzlon have performed, it was not surprising people would start looking for the next turnaround or next kind of multi-bagger from one of these dead and out kind of stocks. And Yes Bank featured a lot in those discussions, right? What's happened is that this anticipation that SBI would want to look for an exit and that would be an overhang on the market actually went out. And the moment the HDFC entities were allowed, it kind of started looking like offering a backstop to what Yes Bank could do. And that's where it's coming. But look at the numbers. It's still, according to me, it's still valued. All the potential improvement that should happen to justify this level. So I'm not a big believer in hope stories. So there is a lot of hope built into the price. There's not much of change in fundamentals from what I could make out. On SBI, I think, Prashant, it's a very clear re-rating that's underway for all PSBs, SBI being the biggest and the most promising. The results seemed tepid. People were slightly disappointed on that particular day, but look at how the stocks responded. It was positioning. Nobody anticipated very great results. And in fact, there was a little bit of an anticipation that this could let people down after the numbers came through. But the commentary has been fairly positive, and they've promised that they've shown that promise that they'll be able to build from here on as things look up and improve. So I think it's more of a re-rating that was kind of overdue. And it's more money moving from private sector banks to the PSBs, and that's largely been the case. So it's more of that. I don't know how long that lasts, because you can't go on the way it's done for the last couple of days. We'll probably start consolidating and go through a time correction.
All right. Prakash, just stay on. I also wanted your views on Honasa, which had a very strong set of numbers, but then valuations are looking very expensive. So I'll give you some time to ponder over that. In the meantime, 76% of the Nifty 200 companies have announced their quarter numbers, and there have been some significant earnings upgrades and downgrades. Prashant has all the data for us. Prashant, you want to take us?
So we do this every quarter, just looking at what the third quarter or any quarter has meant for full year Bloomberg consensus estimates, right, for FY24. We're doing it with earnings season is almost done. I mean, as you said, 76% of the companies have reported numbers. It's a sobering data point, but 52% companies have actually seen earnings downgrades, and only 43% have seen upgrades. What I've done is I've only taken 1% and plus, in the sample, upgrades or downgrades. So this is upgrades and downgrades to FY24, full year FY24 earnings, because there's more certainty with just one quarter left. Just the top upgrades, right? And this is an interesting list. Look at that. It's all new age tech companies. The top upgrades are in the coming through for PB Fintech. It's coming for Delivery, which just reported numbers, and Zomato, which also just reported numbers, I think last Thursday. So, and oil marketing. This is a repeat of what we saw last quarter. IOC, HP, BP are seeing between 10 and 20% earnings upgrades. Stocks have done very well. There's Interglobe there as well, right? 19% earnings upgrade after earnings. Maruti and Trent are the other ones. Trent, of course, is doing phenomenally well. ACC and Ambuja are the other ones which have seen earnings upgrades as well. So again, this is interesting. This is just, earnings upgrades post third quarter numbers for all these companies, consensus. So that's the market collectively. Now, downgrades are, again, the top downgrades are all chemicals. It's a repeat of what we saw in the third quarter. UPL, Navin Fluorine, Gujarat Fluoro, Tata Chemicals have seen some of the top downgrades. The QSR companies, I saw this last quarter as well. Devyani has seen another 24% downgrade to 24 earnings. Jubilant Food has seen a 20% plus. Nykaa is one of those companies from the, if you were to call it new age, which is seeing no upgrades. It's seen a 40% downgrade to earnings. And then there is Piramal Enterprises, sharp cut there on earnings. Adani Wilmar, Loris Laboratories, and some metal companies like Tata Steel and Vedanta coming through as well. So some familiar names and some new ones as well. But I think the highlight is those new age companies which are turning into profitability and seeing sharp upgrades. Sonia.
Okay, well, absolutely the new age companies, right? Let's just take a look at some of the pre-opening rates, by the way. You have the Nifty and the Sensex, which have settled absolutely flat with a bit of a positive bias. So the Nifty is up almost about 30 odd points. And in pre-opening, a couple of stocks deserve mention. Hero MotoCorp is actually down 2.5% post its numbers. So maybe some profit taking is what you've seen. ONGC is down 1.5% as well. And let's take a look at Tata Power, because the earnings from Tata Power were quite muted this time. There was barely a 4% revenue growth that we've seen, so down 1.5%. But GIC RE reported a weak set of Q3 numbers with a decline in the net premium and total income, although the company expects a strong performance in Q4. My colleague Yash Jain caught up with Ramaswamy N, who is the chairman and managing director at GIC RE, began by asking about the quarter gone by and how they see growth going ahead. Listen in.
If you see, our fourth quarter has always been better for us, simply because of two reasons. One, you normally don't have any catastrophes happening during the Jan-Feb-March quarter, both internationally and domestically. So that has always worked for us. So our fourth quarter figures are always better. Second is a lot of accounting adjustments and things like that also happen in the fourth quarter because IRDA had changed the estimation policy this year. So accordingly, if you see quarter on quarter, our figures have been slightly lower because of the estimation policy. On the fourth quarter, everything kind of matches up. So we expect good performance happening in the fourth quarter. So I think investors, I don't want to give a very positive forward-looking statement, but then I think we should be doing better in the fourth quarter. Overall, our figures should be better, and combined ratios we hope will come down by about 3 or 4% compared to where it is today. So we'll be more or less close or maybe slightly lower than what we were last year, but I think it still kind of looks very good from where we are today.
Okay. Now let's start with the third quarter. As far as the premium growth is concerned, at places that faltered, if I speak about the year-on-year premium growth, gross written premium, your gross premium, your net earned premium, they were down anywhere between 10 to 17% on a year-on-year basis, and 18 to 22% on a quarter-on-quarter basis. Right. Simply put, what went wrong, and is that addressable?
Yeah. So this was very clear. So if you see, the difference in the premium is mainly in the domestic area, and it happened in the crop insurance business. Now this year the crop insurance scheme changed, where a different scheme came up, and we felt the pricing had become very aggressive, and so we were not very comfortable. So we came out of 2 or 3 programs that we were writing last year, which is the negative that you are seeing in the premium growth this year. But I think the good part is that will positively affect our bottom line, since we are not writing those business. So it's good for us.
Okay. As far as the net earned premium for the fourth quarter and for the financial year is concerned, the last time we had spoken, you had told us that you expect about 5 to 6% growth as far as NEP is concerned for FY24. Now, with the kind of contraction that we've seen in the third quarter, do you still stick to that guidance of 5 to 6%, or do you want to enhance it, considering difficult part is behind us and fourth quarter looks good?
No, I would possibly say the growth may not be too much compared to last year, simply because, like I said, there was a contraction in this quarter. But definitely we should be able to reach what we did last year, maybe 1% or 2% growth max. Again, for 23-24, we were not looking for growth. We were looking at consolidating and ensuring that we do what we wanted to do. I think the growth will come in the next years.
Okay.
Right. So if you see, for instance, most of the international business happens on 1st Jan. We have not done much. We have done kind of the same kind of business that we did last year, simply because even though we got a credit rate boosting, we still wanted it to be A- for us to write the businesses that we wanted. Hopefully, with the credit rating agencies being happy with what we are doing, I think if we get our credit rating to A- this year, then we will definitely write much bigger business in 25. But on the domestic front, so 24-25, the treaty renewals happen on 1st of April,
correct,
where the work has already started. We've already engaged with all the major partners, and we are also already looking at the kind of business they are going to write going forward, what is the kind of support they are looking for, and where we can step in and provide them the support. So this treaty renewals, we hope to grow quite well in this market, and going forward also with risk-based capital coming in, I think it makes sense for cedents in this market, in the Indian market, to write more business with players like us rather than looking at outside reinsurance. So I think for us, the Indian market is an area where we plan to grow quite well going forward.
What are you expecting in the fourth quarter then on the NEP front? And you said FY25 will be the year of growth. I'm not asking you about one particular quarter of FY25, but for the year, what is the growth that you expect in NEP?
So for FY25, we expect about a 10% growth. Because like I said, treaty renewals, we are already going full blast with all our partners. So we typically expect about 10% growth. This is again assuming that prices don't change. The Indian market still behaves the way it has been. We will be more than happy to write a 10% growth in this market. For this year, I think we will end more or less where we ended last year. So it will be kind of flat or maximum 1% change.
Combined ratio, as you said, shot up to about 120 versus 116.
True.
You had guided 109 for FY24. You're saying that won't actually turn up the way it was planned. If not 109, then where do you end FY24? And then FY25, 107. 100, 200 basis points reduction. Would 107 look possible?
So this year, hopefully, we should be somewhere close to 113 is what I would say.
Okay.
Everything being same, because normally our Q4 is much better than other quarters. If we don't have any bad event happening in these 3 months, I think we should do well and we should be somewhere close to 113, 114. Next year, yes, hopefully we can at least shave off a point from what we did last year. And again, depending on how businesses fare in this market, if there are no catastrophes, then yes, I think somewhere close to 108 is something that is definitely on.
Any discussion between the second quarter and the third quarter with the government on any possible offer for sale in FY25? Is the company planning for it? Has there been any initial discussion on this one?
We've really not had a discussion of this kind. Obviously, the government is also looking at how our performance is shaping up, how analysts look at our stock, how investors look at our stock. So that is something which is happening, and we have been very clearly told to engage with investors and analysts on a more direct basis, on a more increased frequency, so that we understand what is the kind of outlook about our stock. We are very grateful that investors have started liking our stock. They've understood what we are doing, and the prices have gone up. So for those investors who joined us in the IPO, it's good to see that they're finally getting into some money. Obviously, like I said earlier also, the government needs to divest 10%. It is something that is mandated, saying that you need to have 25% of public shareholding. So another 10% needs to be divested. When that will happen is something that the government would take. But we are in touch with government officials to understand, and we are ready. The message that we have given to the government is, if somebody wants to come do some due diligence on the company and want to understand from us, want to discuss with us, we're more than happy to do that.
Okay, that is GIC RE in conversation with my colleague Yash. Let's just take a quick look at what the pre-open has handed us. Pre-open is settled. There's 3 minutes to go for the market open, and the indices will come up. But we want to also discuss about one. Okay, that's 18 points. That's what I was talking about. That's more like it. Instead of a 90 point kind of a higher start, the question is, it's going to be a slower kind of a. That's better. I mean, even if the market has to go up, this is a better opening than going up 90 and then trying to build on it. Okay, Paytm is another one I just want to quickly highlight because it's important news flow. Now, Paytm has set up, 197 Communications that is, has set up a committee to strengthen compliance and regulatory matters. And to this end, former SEBI chairman M. Damodaran is going to chair this group advisory committee. The group advisory committee is going to work with the board to strengthen compliance and regulatory matters. The other two members of the committee are Mr. M.M. Chitale and R. Rajaraman. M.M. Chitale is the former ICAI president, and R. Rajaraman is former Andhra Bank CMD. Now, the reason this is important is because Mr. Damodaran, the former SEBI chairman, brings a huge amount of credibility in terms of trying to rectify the situation, look at what the shortcomings were, and suggest ways that the organization can actually revamp and plug some of these loopholes and gaps. And that's the reason why I thought it's important to highlight this. Credibility and confidence is what Paytm and the stock needs more than anything else at this stage. And Mr. Damodaran brings both of that in good measure. So stock's up about 2.5%.
Would be very interesting to see if some kind of bottom is formed here, right, for Paytm. The stock in any case is reacting well to this. But the other good set of numbers came in from PI Industries. Sonal is here to tell us more about that. Sonal, over to you.
Well, yes, good set of numbers coming in from PI Industries, and this is at a time where the entire industry is talking about headwinds. There is a revenue growth of around 18%. EBITDA is up 34%. The margins have expanded 300 basis points to come in at 29%. Profits are up 28% as well. The company says this was led by the exports business. That is where they saw a growth of 13% because of newer products and volume growth. The pharma segment contributed to export growth to the tune of 10%. It is still a loss-making business though. The domestic revenues, they were subdued with a reduction of 6% on a YOY basis. And the company goes on to say that the pricing pressure and elevated inventory levels that were seen earlier could continue in the domestic business, so that's some negative take there. However, in the export business, they say they have a solid R&D pipeline of diversified portfolio of agrochem, electronic and other specialty chemicals, and 4 to 5 products will be commercialized every year. 30% will come from non-agrochem, so they are trying to diversify a lot to reduce concentration risk. So that's why the stock is on our radar.
All right, thanks a lot for that. Well, there are plenty of other stocks that we're looking at this morning. Good numbers coming in from the likes of Aurobindo Pharma, Easy Trip is planning to open a 5-star hotel in Ayodhya and putting an investment of 100 crores. There's plenty of specific news-based reactions, but otherwise, the market overall looks like it's going to open absolutely flat. So let's take a look at the first tick on the index. 21,800 is what we're seeing on the Nifty. So holding up with a bit of gains, 20 points in the green for the index. But for now, I think the advanced decline ratio also looking pretty good.
No, I think we'll just have the rates up for you. We've got what, 7 points. It's an absolutely flat kind of a start is what we have coming up on the screen. The Nifty Bank is down about 16, 17 points, and advanced decline, as Sonia said, more gainers than losers. So let's put the spotlight on stocks. Sonia has walked over to the wall. Sonia, over to you.
Well, thanks a lot for that. Since the market is very flat, right, I thought let's take a look at some of the individual stocks and how they're shaping up. First up, we have Tata Power, which the earnings were muted, as we told you, and the stock has had a big run-up, so there's a bit of profit-taking that we're seeing there. Revenue growth for Tata Power was barely about 4%. Moving on to, there were many downgrades, by the way, that came in on Tata Power as well, so just keep an eye out on that stock. ONGC is the other heavyweight that reported its numbers. The numbers were fine, but the stock is seeing some profit-taking, down almost about 2%, in line with its revenues, which fell about 1% as well. Hero MotoCorp, take a look at that, 3% lower. As we've been telling you, the numbers were good, but the stock has also run up about 60% in the last 6 months. So there you have it, Hero MotoCorp now reacting to some pressure over there. Apart from that, good numbers coming in from Honasa. That really is, the space to be in, these new age tech companies, these new listings, etc. Honasa up almost about 7% industry leading growth, almost a 30% top line growth. Moving on to PI Industries, good set of numbers coming in over there. The EBITDA was up, the margins have improved, but the stock is coming in for a little bit of profit taking. In the pharmaceutical space, the space to watch is Aurobindo Pharma. The US numbers were a record high, and overall as well, margins have improved. Aurobindo is up almost about 3%, looking pretty good. And as you were talking about Paytm, right, I definitely think some relief rally will come through on Paytm. How long it lasts, time will tell. But for now, the committee has been set up with Mr. Damodaran heading that particular committee for compliance, etc. So Paytm in the green. Indigo Paints, by the way, reported a very good set of numbers as well. So that stock too is in the green, up about 2.5%. But largely, you'd have to say for the market, the Nifty is very, very flat. It's facing a bit of resistance at that 22,000 mark. And here is the problem pocket for the Nifty, right? The Nifty Bank, which is down about 80 odd points. I did see some amount of selling pressure into names like SBI, etc. So do keep an eye out on that. Little bit of profit taking is what you're seeing. Otherwise, it's a very, very flat opening for the market. Back to you guys.
Well, that's right. From the broader market, some of these government-owned companies are taking it on the chin. SJV and the stock is down close to around 10% as we speak. IRDA, that hit 215 rupees just a few days ago, that's come down to around 170 rupees. So a big amount of selling on that one. You have MMTC as well. That as well has done a U-turn. That's down close to around 5% as we speak. What's doing well? Bandhan Bank, some kind of queries with regard to the slippages, but for the time being, the stock has opened up well in the green, so that's up close to around a percent or thereabouts. What's down? MCX and Tata Power, both of them reacting to their numbers, giving them company on the downside. You have Alchem Laboratories that's down close to around 5%. United Breweries is now down close to around 2% as well. And on the flip side, you have Strides that's giving Auto Pharma company on the upside, and Z as well. After a good move, well, it's seeing some bit of follow through. That's up close to around 2% as we speak. So fair bit of movement in the broader markets, while the headline index is as flat as can be. Prashant?
All right. Well, it's a vibrant start on the broader markets, right? So yeah, as you said, SJVN is the top loser. It's down 9% with humongous volumes, 128 on SJVN coming through. NHPC is at the number 2 position in terms of volume-led declines. Market breadth is negative, not by much, but about 200 stocks. But NHPC is about 93. IRFC is down 4%. So remember on Friday, the public sector space saw some pullback. It didn't end at the day's low, but it was down 1.5% or so. Hero MotoCorp, we mentioned, is down 4%. Sudarshan mentioned Amber, which reported a decline on muted numbers. The stock's down 8% to begin the day, 3,800 on Amber Enterprises. More PSUs. IRDA, 5 lower. NBCC, about 3% lower. And Alchem is down about 5%. Midhani, Mishra Dhatu is another sort of company which Sudarshan mentioned as part of his results link. That's down 6%. I mean, there's a sharp compression in margins as well. That's coming down with about a 6% cut. New India Assurance, right? We just heard from GIC RE. New India Assurance is down 2%. Tourism Finance Corporation is down 3%. Sobha is down about 5%, 5.5% odd. So, you know, right out of the gates, lots of stuff moving. And it's a pretty vibrant screen that we have. TRF on the upside, TRF has been moving up very sharply. 3 days back, stock was at about 270. It's at 470 now. That's the kind of move in 3 or 4 days flat. It's up another 9% this morning. Parag Milk reported numbers, I think on Thursday afternoon, was at 3.5 higher on Parag Milk. Birla Corp had a sharp move on Friday. It's up another 3% this morning. We had the management with us as well on Friday after the earnings. KCP, you know, one of those big underperformers, had an 8-9% move on Friday. It's up another 3-4%. So, you know, we'll come back to more stocks on the upside. But as I said, it's a pretty vibrant screen all around, right, at the word go. Although, I mean, the Nifty is also, by the way, up about 34 odd points or so. Well, we have our market master of the day. Neelkant Mishra is a chief economist, Axis Bank. He, of course, also looks at strategy. He's the head of global research at Axis Capital. He joins us from the sidelines of the Axis Capital India Conference, the curtain raiser. Neelkant, great to have you with us here. It's a pleasure having you with us here on CNBC-TV18. Thank you very much for your time. You know, for a conference like this, interest will be in any way high, and interest right now, I'm assuming, is particularly high. You know, the budget just came and went, which was widely applauded for being fiscally conservative, counter-cyclical, etc. Markets have done phenomenally well. What are the top 1 or 2 kind of themes which you think will get talked about the most when you interact with clients, etc., at the conference?
Yeah, so we have, you know, 165 companies, more than 500 clients, several very large FIIs who are attending as well. And I think the interest level would be what really will be driving growth in the next 5 years. So will it be investment? So far in the post-COVID recovery, we have seen investments coming much closer to the pre-pandemic path than consumption. Is that a trend that will continue? What are the new drivers of growth? So we have some very exciting panels on new energy, on electric mobility, on fintechs, and so there is a lot of curiosity about what is it that will be driving growth over the next 5 years, and we hope to answer some of those questions in the conference.
In fact, it's very interesting, Neelkant, you know, people who are speaking at the keynote speakers at your conference are a lot of the players that are increasing their presence in some of these new age areas, right? Whether it is Tarun Mehta, the CEO of Atha Energy, whether it's Kunal Shah, the founder of Cred. I mean, Cred has recently acquired Kuvera, which is big in the fintech space as well. I want to understand a little more about what the focus area for you will be over the next, say, 12 to 18 months. Where should investors train their gaze at now?
See, for the public markets, I think the earnings momentum and near-term valuations should play a much more important role. And I think that the Indian economy will continue to outperform the global setup. And therefore, the domestic cyclicals, the companies that are more focused on the domestic economy are likely to do well. Now, we are headed into a phase, you know, the next 3-4 months where even though the electoral results are, I mean, there's not much doubt left in people's minds, there is still, you know, likely to be some caution. And I think post that you may see, you know, a resurgence in investment. But given that there is monetary tightening, the overnight liquidity conditions are very tight, the fact that the global growth numbers, especially coming out of China and Europe, don't look that good. There is still a risk that perhaps the economy may also you know, slow down a bit. So we are expecting that FY25 could see a bit of a slowdown. But as we proceed and we shape our portfolios for the next 18-24 months, all the areas that we've invited speakers on, things like defense, like electronics, like financials, I think these are going to be areas of interest for us. And these are the ones that we're also recommending to our investors.
All right. Hi, Mr. Mishra. Good morning. Good to see you in. Nigel on this side. You know, talking about shaping our portfolios for the next 12 to around, 18 months or 18 to 24 months, the banking space is calling for attention. And HDFC Bank, the largest bank out there, that's been a drag actually on the key indices. What kind of, feedback, what kind of, data points do you all have in mind? Pitting HDFC Bank, say, with SBI? Because SBI clearly, there's a lot of interest. I think it's the highest that I've seen in the last few years. Your view, sir?
See, I won't be commenting on specific stocks, but I do think that I think the banking sector as a whole seems to be oversold. The concerns around overnight liquidity. See, what has happened is that the RBI's injection of durable liquidity, the implied money injection that the RBI does, has been nearly zero in the last 18 months. So they have kept liquidity tight, pushing up the overnight rates from the repo rate to the margin, the MSF rate. What has happened because of excess cash reserves with the government, either state government or central government, is that the overnight rates have actually gone much above that. And what that means for banks is that now their credit growth starts to get capped. Their incremental short-term funding is actually coming through at a much higher rate, and they're unsure as to how long this continues, and therefore not really raising lending rates yet. But at some point, I think given that the credit demand is strong and the banks should have some pricing power, so as some pricing discipline sets in, I think some of the concerns that have plagued the sector should disappear. The significant outperformance that we have seen for the PSU banks, some of it was just a catch-up on valuations. So you see stocks that were trading at 0.3, 0.4, 0.5 times book, now going up to 0.8 and 1 times book. But beyond that, I think the last 2 weeks, there has been a significant change that we have seen because the market's preferring banks that have low LDRs and have a greater access to liquidity, or at least expected access to liquidity. But I think these are some of these are short-term concerns, and government cash balances as they fall, liquidity in the system should improve, and that should help the private sector.
Neelkant, you know, we've discussed this earlier as well, but now with the budget behind us, I think the increase in capital allocation on capital expenditure in sectors like railways, you know, urban housing infrastructure, roads, you know, it's in single digits. And maybe, obviously, over the last couple of years, the government's done the bulk of the heavy lifting in terms of spending. And what they've allocated for FY25 is a sharp moderation in those, you know, how much they'll spend over 24. Now, those numbers may change, but let's just assume for a minute that the numbers are what they are. Are there any implications for these sectors broadly? I mean, it's a space which has done very well on the back of what the government has been spending.
Yeah, so while I think that the government's withdrawal of support is an attempt to calibrate its own presence in the economy, given that the debt to GDP levels are higher than comfort levels. I would not really attribute to the recovery that we have seen in the order books of industrial companies to just government spending. Government spending as a percentage of GDP on capex has picked up a bit, but from 2019 levels. But if you look at levels from say 2012 or 2008, when the last two peaks for GFCF, the gross fixed capital formation, had happened, those numbers are not much higher. In fact, what is starting to happen is that after a long time, you are seeing the requirement for industrial capex, and there's also visibility and comfort on the underlying growth, so that companies can invest in their future. So on things like utilities, on materials, on energy, these are the three heaviest contributors to capex. So these are starting to revive. I don't think the government can invest a lot more. So especially if you think about the central government, the two sectors where they can deploy significant amounts of money are road and rail. And on railways, I think the expectation should be that that capex in the next 3-5 years will be much higher than what we saw in the previous 3-5 years. On national highways, I think the phase is now of commissioning, and frankly, much more of acceleration on this base is perhaps not necessary. So I do expect that in the next 3 years, as we think about the industrials and the sector, it will be driven primarily by private sector capex and the pickup in dwelling construction, both residential and commercial.
Okay, all right. We'll leave it at that. Thanks a lot for joining in. Appreciate your time here on CNBC-TV18, Neelkant, and we will, of course, come back to you later have a great conference. We'll come back to you after the conference comes to an end. That is Axis Capital. They have an Axis Capital India conference, which is going to be kicking off. And of course, the interest over there is immense. But let's get back to the markets now, which is absolutely quiet. The Nifty is hanging on to 21,800. Bandhan Bank reported a weak set of earnings for Q3. The asset quality deteriorated, slippages were elevated, net interest margins also flat sequentially, and the stock is down about 2%. Chandrasekhar Ghosh, the MD and CEO of Bandhan Bank, joins us now to talk more about that. Mr. Ghosh, thank you so much for joining in. You know, this has been a quarter where a lot of banks have not only managed to improve their asset quality, but have seen a lot of strength because of the improvement that we've seen, across both corporate as well as retail credit. But despite the industry doing well, your asset quality has been under pressure. Can you tell us why that is and what is the way forward? Do you think things could get worse before it gets better, both on the slippages side as well as on gross NPAs?
Yes, thank you. The asset quality isn't very good. We are moving out from NPA. If you see that our total NPA has come down 30 basis point from 7.3 to 7%. I'm not only talking. If we see that the DPD as the group loan, and which is called the EEB credit, and this is the EEB card. The quarter-on-quarter basis this financial year, on that our DPD has come down. That means the very good portfolio has come. Second point, if you see that the out of my EEB book, 85% of the book are this financial year what we disbursed. And this loan, we are find out on that their NPA is a 0.11%, which is the out of this the book, only 35 crores is NPA. So we are seeing that whatever the early book, which is called in the time of pandemic and after the 1 year of pandemic, that book a little bit the stress, and gradually it has been coming up as a good book, which have been showing on that the NPA future is coming down.
Ghosh, can you give us some numbers? When you say NPA is coming down, your gross NPA ratio is still at 7% plus. When you say coming down, how much do you plan to bring it down by? And your slippages ratio as well has been above 4% for a while. What on those two numbers, gross NPA and slippages ratio, what is the expectation?
No, if you see that the gross NPA 8,000 crores on that. No, and the major the gross NPA is coming from the EEB book. And the all together in this, out of this EEB book, as in if you see that the before the 21, that means the financial year 2021 up to, if we see that it is a major 3,600 crores. So this if we like to remove on this one, then it will be very low NPA of the bank. So we are gradually recovering of those amount, and that will be like to show that the future is a good portfolio.
Okay, all right. Hi, Mr. Ghosh. Good morning and good to see you in. So we've discussed a fair bit about your asset quality. Let's focus on a couple of other aspects. The street is a little bit worried about the liability side. What are you going to do to shore up the deposit growth? Point number one. And also in terms of advances, loan growth, what can you guide for, say, for the end of this year as well as the next year?
If you see that the first point on that, by our deposit growth has come 15%. And we are retain our retail deposit is stronger, which is a 71%. And if we see that our it is in CASA is a 36.1%, and we shows that on that the very strong deposit growth has come to the bank compared to the industry also. So we are going to continue because of that. Couple of point is there. One point is there that we are last couple of quarters open the 500 branches, which is coming to the production in now and the future. It has been helped us on that the continue in this way to grow to the deposit book in a retail segment, including the CASA. And this is the my point is there.
Okay,
And,
what does it mean, sir? Loan growth for the year? What can you guide? If you're satisfied with your deposit growth, what kind of a loan growth are you targeting?
We are seeing that the advance growth will be already has come on the 18.6%. I hope that this financial year will be continue on that, or little bit slightly more on that.
All right. Okay, Mr. Ghosh, good morning. And since we're talking about guidance, NIMs would be around, what, 7.5%? I'm talking about FY25.
No, if we see that I'm not able to talk about the FY25 because my strategic meeting is coming to the next month. So after that, I'll be like to guide it on that. But as of now, if it is a financial year 24, we are guided on that the 7 to 7.5% will be like to maintain the NIM. And if you see that the very tight in the market of the liquidity and the price also increase on that, after that also we are continue on that from the last quarter to this quarter, 7.2%. It's a very strong base because of our bad portfolio is going down and the quality of the portfolio is coming up. That have been helped us on that to maintain on this 7.2%.
Okay. Mr. Ghosh, just one point. The number of MFI customers for Bandhan fell on a quarter-on-quarter basis. Is that, could you tell us what happened and why is that?
No,
the customer count.
If you see that there is a 3 lakhs customer has come down the last quarter, and it has been happened on that. The microcredit always the credit is coming the demand from the customer in the January to March, and this is the way when the customer are close the loan even in the month of in the month of December. They are not taking the loan in the December. They can be someone taken the loan in January, someone take the loan in February when their season is good. And that will be like to, again, they are coming on that time and that will be fill up on that. So this is the way happened on that. So it is not in a unnatural, it is a natural scene we have been seeing that. Second point, if you recall on that, the December is a little bit is a holiday mood. So people are normally close the loan and we are given the loan of the minimum 1 week later. So for that reason, it is also shifting to the last week of the December. All the closed loan will be eligible to the January. So in that sense, it has been shifted from month to month and sometimes it is showing on the quarter on quarter.
Mr. Ghosh, by when can we expect your refund to come in from the government under the National Credit Guarantee Trustee Company?
No, if you know that there is an audit is the details is going on, and whatever they have the need of this information, all information are provided, and we are waiting for that the final report will come, and accordingly we'll be like to get the funding.
Any kind of timeline that you're looking at? Is it expected in this calendar year itself?
We are expected in this calendar year, but of course there is some of this the few days in the later or earlier.
Okay, a calendar year, so you want to give us a quarter by when you can receive it?
No, calendar year means in that if I say that this financial year, I'm not the commit on that point of view, but I feel that this financial year, it will be come or some of the days will be like to next quarter.
Okay, so we'll keep it to calendar year for now. That is by December 2024 is what you're telling us, right?
Yeah, yes.
Okay, got it. A final question before we let you go. Any fundraising plans you have, say in the next 12 to around 18 months?
If you see that the including our the profit, we are nearly maintaining the capital adequacy is at 20%, and we feel that a very strong capital adequacy of the bank to grow in future whatever we are guided on that, the percentage of the advance growth. So we have not any plan to further raise the capital.
All right, we'll leave it at that, Mr. Ghosh. Thanks a lot for joining in. Appreciate your time here on CNBC TV18. That's Bandhan Bank. The slippages were elevated this time around. The numbers were not good. And I think the street has, taken note of that. Look at the stock down 3.5% at a time when a lot of banks are seeing an improvement in asset quality. Bandhan Bank saw a deterioration, and that's something the street didn't like. Let's do one thing. Let's take a quick break. On the other side, Ramesh Gehani of Endurance will be with us. They'll talk about their Q3 earnings. There has been a recovery in the European segment for them, so more on that later. We will also connect with Ramanpreet Sohi of Honasa for their Q3 performance. He's the CFO of the company. More on that in a bit. Welcome back to Bazaar. Well, as promised, Endurance Technology is the stock that we're looking at. The company reported a strong set of Q3 earnings. Their revenue and EBITDA saw healthy gains, but the margins actually came down 100 basis points sequentially. Ramesh Gehani, the Executive Director and CEO of Endurance Technology, joins us now. Ramesh, thanks a lot for joining in. I want to first start by talking about the top line growth, right? If you look at what's been happening in 9 months, the revenue growth has been about 15%. But you've had some struggles in the European market, which is now seeing a bit of a recovery. Tell us, how is the situation on the ground, and what do you think you can end the year with? What is the likely growth that you're expecting to see in FY25?
Good morning, Sonia. Well, it's really promising to see that Europe is doing better. And after a very long time, we've seen a good December also, a good Q3. So let's hope things turn out better. 13.3% increase on the new car registrations is a handsome number. If they continue with this, I think we'll have a very good year. And if we continue like this, I think a promising year awaits us by the end.
Give us a number. I mean, you say promising year, right? I mean, this quarter, you've seen a 22% growth on the top line. Is this something that you can replicate in Q4? And what about FY25?
See, you must appreciate one thing, that the auto industry is dependent on the OEM performance. So are we. I would look at it from a different way. How much are we performing better than the industry? And if you look, 5.3% or 5.8% has been the overall growth of the industry, and we've been up by 15% more. So our stand since the beginning has been that we'll perform better than the industry, and that is something that we always target upon, and we'll keep on maintaining that.
Okay, all right. Hi, Mr. Gehani. Good morning and good to see you in. I want to focus on the electric vehicle segment. Out there, your order value has risen. I think it moved from around 90 crores to around 380 crores in FY23 itself. Could you tell us what is the trajectory from here on? And as a percentage of business, how much can it contribute, say in FY25, FY26 onwards? Mr. Gehani?
Let's look at it differently. Yeah. We have acquired around 600 crores. Hello? Am I audible?
Yes, sir. Yes, you are. Please go ahead.
Yeah, we have acquired approximately 600 crores. We've acquired 600 crores of business, of EV business, and we are expanding our way, not only casting, braking, and suspension, but we're also looking at BMS taking the next leap on the electric side. So there also the numbers are increasing. Our order wins on EVs has been good, and as I said earlier, that we were a late entrant in this, but now we are catching up very fast. And suspension and braking is showing very good results as far as the new business wins are concerned.
So EVs as a percentage of your overall business is now about 42%, right? At the end of FY23, that is. Where do we stand at as of now? And over the next 2 to 3 years, how much do you think you can take the EV pie to?
See, it depends on how the EV space, moves up. The OEMs have got to perform. There are more and more new players coming in. Some people are struggling with the, FAME subsidies and so on. But once that, then you can see, the numbers coming up faster than what we see today.
In Q3, right, you won new orders worth 160 crores in India and 9 million euros in the EU market. I want to understand, what is the order visibility that you have over the next 12 to 18 months, over and above these orders?
So let me put it a bit differently. We have won approximately 250 million euros of business as far as EVs, out of which 209 million euro is EV alone. So we are at a very handsome space as far as the performance is concerned. And likewise, in India, 600 crores doesn't match up too much with the kind of growth that we have seen in ICE, because the high-end bikes and all have found a good space, a good audience on high-end bikes. So there's been a bit of slowdown as far as the EV performance is concerned, but I think some of the OEMs are doing extremely well, and the numbers are catching up very fast, on which we are largely present. We've got a very good share of business on them. So I think it will be a mix of two things. One is how much of business do we acquire, and at what speed the OEMs progress on the EV space.
Just one final question from my end on the Maxwell business. That has been improving as well. I mean, your revenue has more than doubled year on year on a low base. By when do you think you could turn into profitability for the Maxwell business?
That's a good question. See, we have already said that we'll be EBITDA positive by Q1 of next year. So from there, as the numbers move on, see, we have been supplying BMSs, very strong numbers, and we've got a very strong position in the market, because more than 150,000 BMSs have been applied onto the Indian road conditions, which means that our understanding of the Indian road conditions is very strong. And we are we've got the capability to look into any fresh requirements that come in, or any change in configurations which come in. We can adopt that very fast. So I think our progress at Maxwell will also be very good.
All right, we'll leave it there, sir. Thank you very much for joining in, and great conversation as always. Good luck as you look ahead. Just want to make a quick mention. The market has come off. We're down 47 points on the Nifty. This after dilly-dallying for the last 15-20 minutes. There is a bit of a, I'm not sure if this is a firmer kind of a move, but we are at the day's low now. And two specific names. One is Zomato, which reported on, I think, Thursday. Friday, of course, we saw some reaction. It's up 4%. In a down market, Zomato is up 4%. And I highlighted that, not just Zomato, but PB Fintech and the other ones. The new age ones are seeing the upgrades because of turnaround, etc. That is 155. And look at something like we don't talk about it at all, but KCP Limited. I think it's just because it's cheap. Nothing else, not very much else, unless there is something at the margin. But it was up 15%, KCP Limited. It's up about 11% or so. So keep an eye out on that. It's a second day of move after last Friday. So just spotting some momentum before we go any further. Now, Honasa Consumer is also on our radar. Stocks up. Their third quarter earnings were strong year on year, some 28% jump in revenues. Stocks come off about 4% from the day's high right now with the market. Volume growth for the company is coming at 35%. We have Ramanpreet Sohi, Chief Financial Officer of Honasa Consumer, joining in to take some questions. Ramanpreet, great to have you with us here. Good morning. Thanks for your time. Prashant this side. When you see 30% growth, the question which comes to one's mind is, will we see continued 30% kind of growth come through in the future as well? Can it be as strong? I think at the margin, you guys are highlighting there is some slowdown in the urban markets, etc. Is that just very near-term concern, or is that a slightly more medium-term concern as well? That is one. And if you can detail out what has been the growth for the Mamaearth brand for the third quarter and for the 9-month period as well. Go on.
Sure. Hi. Good morning to you, and thanks for having me here. So I think, like you said, of course, I think we've delivered, a strong quarter. We do, of course, see, some level of demand softening, especially in last 3 months during the festive season hasn't panned out well. The e-commerce platforms are also seeing some bit of softening. And, of course, also, what was sort of impacting rural markets earlier, we are seeing now sort of trickle down to urban markets as well. So I think, our focus is to continue to focus on building up brands, continue to expand our omnichannel distribution, and continue to focus on delivering 2 to 2.5 times faster growth than the markets. And I think the other question on Mamaearth growth. So I think we don't, of course, disclose brand-led level growths, but I think it continues to deliver double-digit kind of value growths and sort of teens volume growths for the brand. So of course, as we see some headwinds, there could be some challenges from sort of continuing the similar momentum, but very clearly we'll continue to drive growth and grow faster than the market, at least 2.5 times faster than the market is how we see things unfold for us.
Ramanpreet, for Mama Earth, in the ballpark, is it 9-10% growth, 9-month period? For the 9-month period? Because it's a large chunk of your business, 60-65%. Yeah.
Yeah, I think, well, I mentioned that, right? So, we don't really comment on specific brand growths, but I think it's a double-digit kind of growth and teams kind of volume growth. So volume growth is ahead of value growth as we sort of focus on driving penetration. Clearly, where volume growths are ahead of value growth. So that's probably how I would like to put it.
All right. Hi, Ramanpreet. Good morning and thanks so much for joining in. Nigel on this side. So we've got that top line growth. You'll keep saying that you're going to outperform the industry and you'll have managed to do that. So good on you all. I want to focus on profitability a little bit. Could you give me two numbers? One is ad spends as a percentage of sales. What does that number come down to? Point number one. And what does it mean in terms of EBITDA margins? Because clearly things have been looking up on both those two fronts. The ad spends are coming down. The EBITDA margins are improving. Please go ahead.
Sure, absolutely. So, I think what we've also said in the past is that we clearly see levers of margin expansion of 100 to 150 bips from an year-on-year perspective. Having said that, this year, of course, A&P, which is the ad spend, has come around 34.5-35% average for the first 9 months. And this is almost a 200 bips optimization efficiency in the A&P spends for us, which is, of course, apart from, let's say, some leverage on the other expenses and some leverage on the employee cost, we've been able to see almost 400 bips margin expansion this year. As we look ahead, of course, very clearly, A&P is going to be a key leverage driver for us as we look ahead into next year. And I think, we're clearly building those levers that we'll see 100 to 150 bips sort of margin expansion from here on. Currently, I think as things stand, this year, we are at about 7% EBITDA margin, which is a 400 bips expansion led by A&P. So I think that's how we are sort of looking at building the business and in terms of unlocking margins from here on.
So next year, we should be looking at double-digit margins.
I think our focus is, and again, I think we clearly see levers of 100 to 150 bips expansion from here on. We are at about 7% now.
Okay, 100 to 150 bips expansion is what you see from here on your margin front. Got it. Ramanpreet, hi, good morning. So I want to get back to the consumer demand a little bit. You said that things have been tough. I want to understand for your other products, right, other brands, whether it's Derma Co, whether it's Dr. Sheth, Be Blunt, Aqualogica, how long do you think it could take before these brands turn EBITDA positive? I think Derma Co has already achieved that status, but if you can just give us the outlook on the others.
Sure. So absolutely. Hi, good morning, Sonia. So absolutely, I think as we've seen scale up of our younger brands, especially Derma Company, our second largest brand, it is in fact not only turned profitable for the quarter, but in fact it's profitable for the entire first 9 months. So we clearly see at a certain scale, brands become profitable and then add incremental margins. And also for our younger brands, Aqualogica, Dr. Sheth, they also, good annual run rates for last quarter. We've sequentially also grown those brands. Clearly at every scale, incremental scale, we're seeing efficiency come in, and that's also showing in our overall margin profile of the business. So that's how we'll sort of continue to build them as we look at next year. The Derma Company, a second largest brand, will continue to focus on further improving its margin profile, and we'll further see efficiencies driven across younger brands as well as this scale. I think currently all the brands are online first, digital first, and as we sort of build them, we've very clearly seen efficiencies across our younger brands.
But since you mentioned, you started by saying that, consumer sentiment is quite tough. Things are not as good as they were in the preceding quarters. Do you think it would be hard for you to maintain this 30% growth that you've been doing for the last many quarters? You think that will be a tall ask?
Yeah, I think in terms of, it's difficult to sort of clearly pinpoint what will be the level of growth. I think we continue to say we will grow faster than the market. I think in terms of, growth numbers, we've also sort of talked about in our call. We are expecting about, at least in the near term, 20% kind of plus growth, around 20% growth for our business. And of course, one of the big challenges is how the consumer demand pans out in the near term.
Ramanpreet, so is it fair to say that near term you will continue to grow, as you said, aim is to grow at 2.5 times where industry is at. But at your level, would you say in the near term, perhaps growth rates will start to come off a little bit?
So I think there are of course challenges. We continue to focus on. For us, I think there is a big opportunity out there. We're present in about 1.7 lakh retail outlets on the offline side. We continue to build our younger brands, and they're scaling really well. So I think it's difficult to clearly pinpoint. Yes, there are challenges in the market. Consumer demand is a challenge as of now. Especially, it's also impacting urban markets. We see some level of growth sort of coming off, but clearly, the level of growth that we are at, we will continue to be much faster ahead of the curve. But at the same time, also continue to build the business efficiently as we look ahead.
All right, Ramanpreet, what about market share? In the face wash as well as shampoos, I think there has been some increase in market share. What's the targets out here?
No, I think that the clear targets, I think on the market share side, both face wash and shampoos, we continue to sequentially also see some level of market share improvement. Our household penetration data is also giving us a lot of confidence, and there also we've seen good wins on the penetration side. I think the focus is to continue to reach more and more consumer, continue to get into more and more households across the country as we expand our distribution through the offline platform for Mamaearth, and as we further deepen our penetration on the online platforms through our younger brands. So I think that's the focus. Our focus is to continue to gain market share. We are, of course, at a level where there is a clear headroom for market share expansion.
So you told us that Derma Co has been profitable for 9 months of FY24, and there is growth in the other brands as well. But I was asking you about profitability of the other brands. So whether it is, Dr. Shades, Be Blunt or Aqualogica, by when do you think you can get to profitability for these brands?
So I think, we don't obviously comment specifically on the brand profitability. Like I mentioned, clearly there is efficiency. The margin profile has improved. Of course, all apart from Derma Company, our younger brands are in an invest phase. But, there is margin or, efficiency improvement. I think, in terms of, I think difficult to give a clear timeline, but, given the trajectory that we're seeing, given the Derma Company in its third year, third year's turned profitable, very clearly we also see younger brands probably hit the profitability levels much faster than Derma Company, in fact. So I think with the trajectory that we see, we are very confident that some of these brands will start becoming a bit positive, down the road for us.
Ramanpreet, you said there's scope to improve margins by 150 basis points, right? So a couple of points. Over what time frame is the primary lever to be able to do this is to reduce advertising spends, or are there any other levers? And because you'll go through a phase as you expand, offline, of course, is more profitable, higher margin, and you want to build that out more. But that also requires investment. So just trying to understand how this is going to go on the margin front.
Sure. No, so I mentioned about 100 to 150 bips. So I think we have clear levers. A&P marketing spends are going to be the biggest efficiency driver. When we say, that's the biggest lever. I think you mentioned that you're going to reduce A&P. We're not going to reduce A&P. A&P from a year-on-year basis at an absolute level will actually increase, because I think we are investing behind brands. We want to ensure that our brands are well invested, and as we sort of continue to expand our market share, of course, at an absolute level, there will be an increase, but as a percentage of sale, there will be unlocking, which will, of course, help unlock margins. I think the biggest lever is going to be A&P for us, as we see efficiencies across younger brands, as we see our largest brand further deepen penetration on the offline side. We clearly see efficiency kicking in on the A&P side, and also there will be some leverage across other aspects of the P&L, but the biggest lever will be a marketing spend for us.
All right,
All right,
we'll leave
we'll,
it there, Ramanpreet. Great speaking with you. Good luck with the business, and it's a pleasure having you with us here on CNBC TV18. Thank you very much. That's Honasa. Stocks up 2%, 2.5% in a market which is not up. It is down. We're down at the, I think at the day's lowest point. It's a 65-point cut.
There's a big accident in the broader market, and that is today's accident is SJVN, down almost 14% now on SJVN. It was a pretty weak quarter for them. The net profits were down 50% for SJVN. And I mean, you know, hydropower, etc. Some of these segments saw a big fall this time, but the market is now in a mood to sort of, you know, crack down on any weakness in earnings.
Sonia, look at the small cap index. I think it's the third day where the small cap index is down, and today it's down 1.8%. On Friday as well, I think we ended about 1.5% lower on the small cap index. And that's the BSE small cap. I'm looking at the Nifty small cap. It's almost a 2% cut here, 1.9 actually on the Nifty small cap. And maybe the mid cap index perhaps also, it's down a full 1%, mid cap index. So yeah, well, the Nifty is coming off about 75 points. In the broader market as well, there is clear pressure. 600 stocks are higher and 1,600 stocks are lower.
Okay, and you know, as we were telling our viewers a couple of days ago as well, right? PSU stocks have been under a lot of pressure. Money is being taken off the table there. But more on that later. When we come back, we'll get you a snippet from our special offering, Future Female Forward, where CNBC TV18 honoured women trailblazers and pathbreakers. Here we are honouring Shaheen Malik, an acid attack survivor who is empowering the lives of other victims through her own NGO, the Brave Souls Foundation.
Ladies and gentlemen, please put your hands together for Ms. Shaheen Malik with a huge round of applause. Ms. Malik's activism and efforts in championing the cause of women's safety and empowerment reflect her dedication to ensuring justice and equality for all. Let's celebrate Shaheen Malik, a true warrior in the fight for women's rights, whose work continues to light the path towards a better future for every woman and girl.
Thank you so much for joining us.
Welcome back to Bazaar Morning Call. Let's talk about some pharma stocks now. A lot of them are buzzing in trade. Aurobindo Pharma is really the one that's up almost about 3% odd. Ekta's here to tell us why. Ekta, over to you.
Thanks for that. Well, overall, it was a good set of numbers for Aurobindo. Like I mentioned earlier, you know, the US revenue was better than expected and the margins came in at around 21.8% as well. Now, they did hold their investor call. A couple of important takeaways, especially on Eugia Unit 3, which was inspected by the US FDA, received 9 observations. They have indicated that they will be submitting a response on Eugia. And as of now, due to abundant caution, they have stopped manufacturing at the site until investigation and assessment is undertaken. They could probably see an impact of even $20 million in Q4 due to Eugia 3. But overall, they are still confident of achieving 20% margins. Also, the company was not expecting major approvals for Eugia in FY25, FY26. They expect that growth will mainly come from the likes of Revlimid generic as well as from new launches, whereas 50% of those new launches, which are estimated at 35 to 40 million totally, 50% are from Eugia Unit 3 and the remaining are from balance manufacturing sites. So I think the street has undertaken the fact, or they've absorbed the fact that, you know, maybe there could be a quarter or two in terms of impact on account of Eugia, but overall the company is being proactive and taking the necessary steps in order to remediate the plant.
Okay, some more pharma stocks that you're tracking. There's Divi's Labs, there's Dr. Reddy's. Ekta?
Well, yes, for Divi's Labs, in fact, you know, the numbers were disappointing this time. The revenue was up around 8.6% versus estimates of over 20%, margins 26.4%, Street was anticipating 29%. But like I mentioned, the commentary probably assuaged a lot of those concerns. GLP-1 opportunity, according to them, is likely to contribute from FY25. The company is already supplying amino acids for it as of now. And the company is confident on double-digit growth. They have custom synthesis where there are 2 large projects from Big Pharma. Remember that the stock is also corrected significantly. It's down around 10% from its 52-week high. It's trading at around 41 times FY25 PE. So maybe there is some amount of upside on account of that. Separately, just want to point out for Dr. Reddy's, the FTO unit, one of their units has in fact received a voluntary action indicated status which is a part of the EIR Establishment Inspection Report. Now, there was concern with regards to FTO Unit 3 simply because it had received 10 observations, and it's a very critical part of Dr. Reddy's new product launches as well as the current manufacturing. And hence, with the VAI, the street now knows that the observations are probably behind them, and hence they can probably not have any kind of earnings risk going forward.
Right. Ekta, thanks very much for that. So that's pharma stocks in focus. But Hero MotoCorp is the other one which is on the move. Sonia, tell us more.
Oh, absolutely. So, the stock is under a bit of pressure right now. It's down about 3% odd. Now, there was no positive surprise in the numbers. The numbers were largely in line with estimates, which was expected to be good. But there are some brokerages which believe that the stock has run up quite a bit. So, maybe you need to be a bit cautious there. Goldman Sachs has a sell. They have a target price of 3730 on the stock. They say that Q3 numbers were in line with street expectations. They are seeking a market share pickup in the electric vehicle and the ICE segment. Hero expects the FY25 industry revenue growth to be in the double-digit range. The two-wheeler portfolio is presently at 16% EBITDA margins, enabling a 125 to 150 basis points of annualized EV business investment. Morgan Stanley has an underweight. They have a target price of 36.38. They too believe that there was no positive surprise in this quarter's numbers. It was in line with estimates. The management is executing well on its strategy. The market share gains in the premium segment will be the key to track. Now, disruption risk in the core segment and elevated valuations is something that keeps them underweight. So numbers are good. The execution is well on track, but it's really valuations that are making brokerages a bit uncomfortable at this point in time. But let's find out what's the latest on ONGC. Sonal is here with more. Sonal.
Thank you so much for that. Well, it was a largely inline set of numbers. If you look on a quarter-on-quarter basis, the revenues declined 1%, EBITDA was down 6.5%, the margins declined to 49.3% versus a poll of 49.7%, so a mild miss there. Profits were down 6.5%, but they were higher because of a component of higher other income that came in at 3,400 crore rupees. But both crude and gas production, they declined on a YOY basis, so all eyes on the new production from KG Basin. Crude realizations largely in line with estimates at $81.7 per barrel, but the stock is lower, one, because it had run up before numbers, and second, the margins have come in slightly lower than estimates, and the outlook is on production going forward, so that's why the stock is in focus.
All right, Sonal, thanks very much for that. Well, we'll take a quick commercial break here. My colleague Lata will get chatting with Pravir Sinha, Managing Director and CEO at Tata Power, and to talk about the third quarter performance. Stay tuned.
Welcome back. We are still with earnings analysis, and Tata Power's third quarter profit is the one we are analyzing. Looks like it has disappointed the street largely because the company has earned less from its coal business. So not its core business. Core business has done better. The stock is down over 4%, but the company's core business, like I said, of power generation and especially distribution has done well. There is a lot of interest in its solar rooftops business after the government recently announced the Suryodaya scheme by which rooftops will be given to about 1 crore homes. So that may be more business. Joining me now for an update is Pravir Sinha, Managing Director and CEO of Tata Power. Good morning, Mr. Sinha. Thank you very much for your time. Well, first, let's come to the coal business itself. What's the in-house view? Is this coal price a passing thing? Do you expect to make more money in the current quarter from coal and the next?
Good morning, Lata. Thank you for having me on the show. First of all, I think this is the 17th consecutive quarter in which we have shown a growth in profit and EBITDA. The second thing is that this is a very satisfying quarter because our core businesses, which is our renewable and our transmission distribution and of course coal, have given more than 70% of our profit, which last year was only 40%. And we were more dependent on the coal profit, which last year, because of high prices, gave us a huge profit. But now that the coal prices have stabilized, we do not expect that sort of profit coming in. Of course, they will give profit, but not to the level that we had seen last year, which typically was a one-off and was not seen even prior to that. What is important is that notwithstanding the contribution from coal, all others have contributed. And today, not only this quarter profit has gone up, but if you see on an overall basis in last 3 quarters, we are at 3,000 crores, which you would be aware 3-4 years back, our annual profit used to be some 1,300-1,400 crores. So this is a hugely better performance and gives us a lot of satisfaction that going forward, how we will make this core business profit not only 70%, but enhance it to 80 and 90% in next 1 to 2 years.
No,
and
no,
we
that
are on
is
track.
taken. Yeah, Mr. Sinha, but you know, your stock has anticipated that profit. It was about 200 rupees a year ago, now over 400 rupees. So the stock, people expected and you delivered on that point. I'm not taking away from the profit growth, but that's already in the price. The market wants to know how much more. And that's why, you know, my question to you. Let me come to the solar EPC business. You all are becoming much more a renewable company. According to your own targets, maybe 79% by the time you come to 27. So solar EPC business, you, I think if I remember right, said you are slowing down about a couple of years ago, but it's done well. Can you tell us what are your expectations in the entire solar unit, both manufacturing of modules and the EPC business? What are the plans?
So our renewable business is doing very good. And what we are seeing is that there is a huge support and traction from the market as well as from the government. As far as the manufacturing plant is concerned, the 4 gigawatt cell and 4 gigawatt module, we are very much on track. The module plant is already operational. It is started producing and will start supplying modules in this quarter to our large utility scale projects and some of the other EPC projects, where the domestic manufacturing of modules is required. We expect the cell plant to be ready in the first quarter of FY25, and it will stabilize by second quarter. So we are very much on track. And what is also good is that it could not have been a better timing, because with 1 crore rooftop solar, which will require DCR modules, we will be in a very good position to supply it to the rooftop business that is expected to come up in next few years. Secondly, on our utility scale, we have been implementing some projects. We went little slow last year because the prices of modules were very high when we were importing. The prices in last 6 months have come down, and you will see a huge amount of EPC projects and our own utility projects coming in the quarter 4, and also in the subsequent quarters in Q1 and Q2 of FY25. So capacity addition in quarter 4, we are expecting nearly 1.2 gigawatt, and similar numbers will happen in the subsequent quarters. So I think we are doing very good as far as our both utility scale and EPC business is concerned. And the decision to delay some of these projects in the earlier quarter has bore fruit to us in terms of getting a much better returns in the coming quarters. Coming to our rooftop, I think we are the market leaders with nearly 18% market share. And with more and more support that is coming from the government side in rooftop, we will continue to have leadership, but also have huge volume that will happen. So our renewable business, you will see, will really take off in a very big way in the next 12 to 18 months. Many of the challenges that we have overcome them with a safe supply chain from our own manufacturing plant. We'll be able to cater to our own requirement of utility scale, as well as sell some of the modules within the country or outside the country, and thereby improve the margins of these businesses.
Okay. Well, let me take one by one the things that you said. The module volumes, when it's at the moment, what, 2 gigawatts? When and how much do you see it ramp up to?
So already we are producing 3 gigawatt of modules, and within the next few weeks we will have. We are producing 3 gigawatt right now, and in next 3 weeks we will reach our full capacity of 4 gigawatt. Similarly, our cell capacity will start producing in first quarter, and by end of second quarter of next financial year, it will be producing at full 4 gigawatt capacity.
Okay. You had said that you would go a bit slow on the solar EPC, but it's giving you good returns. Will you be able to improve the margins, and what are the plans? Ramp up or remain steady on EPC?
So we earlier used to do more of third-party EPC and less of our own utility scale. Now that we have ramped up the capacity of our own utility scale and group captive, we will do less of third-party EPC. So earlier, which used to be about 50-50 outside and our own, we will now possibly have 70% of our own and 30% outside. So that's where we will ensure that our margins are better and we have a much better control on the supply chain.
Okay. Any chance that you may be able to sign something for Mundra as well? It is still under Section 11, like no profit, no loss. But is there any hope at all that you will be able to reach a longer term PPA and it might turn out to be out of Section 11 and a profit-making company?
Absolutely. And one thing is certain is that Mundra is a very important component in supply of power to the 5 procurers. And in their merit order, they find that Mundra tariffs continues to be very, very competitive and low compared to alternates which they buy at a higher price. Having said that, they are also very keen that this should be settled in such a way that it's fair to both sides. And to that extent, we have been in discussion with them. Now that the Section 11 is there, they want that within this period of Section 11, they come and have a mutual discussion, whereby we come to an understanding which is fair and reasonable to both sides. And I'm very confident that it will happen because this plant is required by all the procurers, and this power will definitely support them in meeting their obligations.
All the 5 states?
Yes, absolutely.
Okay. A quick word on this PM Suryodaya Yojana. I mean, we'll have to call you on that separately because it's a huge thing. But were you in when the scheme was being drawn? We don't have much except some 10,000 crore that has been assigned to it in the budget under the Renewable Ministry. Can you tell us when it takes off, and will we see some benefit for you in FY25 itself?
We were, of course, the discussion took place, and I think stakeholder discussion was done actively for last few months, so that whatever challenges which has been faced earlier in the penetration of rooftop solar are addressed comprehensively. And I think we'll see more of the details coming up, but there would be definitely a little more of subsidy and the financing support which will be provided. And also how the DISCOMs will support the consumers in doing the bi-directional metering. So I think this has come at a very right time. And when the prices have come down, also the manufacturing capacity has come within the country, we'll be able to cater to a large number of people in terms of providing this rooftop solution. For us, this is a very big opportunity because we are already very big in terms of rooftop. We are in nearly 400 cities with 500 channel partners. And we will further enhance it to meet the opportunity which the government is presenting. We will play a very, very important role with nearly 18% market share. I think we will only increase in the coming years.
Okay. So there's lots more to discuss with you on distribution and EV, but all that for another day. Out of time today. Thank you very much indeed for joining us with a good perspective on how the renewable business and the Mundra business will progress. We have to wrap up on Bazaar on a slightly negative note. The market is perhaps at its lowest point, but you have to blame the US yields for it. At almost 4.2%, it's pushed up Indian yields as well. So that's casting a negative hue on the markets. Let's see where it finds support. Wrap up on Bazaar, Chartbusters coming up.